Hello friends, welcome to Learning Sessions, and today in this video we are going to talk about the Spac, that is a special purpose acquisition companies, and this is the last chapter through the module D of Abfm. We have covered each and everything related to Abfm in detail, so if you want to go through the videos, simply do subscribe to our channel, or you can simply visit our portal caib.learningsessions.in, where on sign up you're getting all the PDFs of all the 9 papers free of cost just on sign up. So do hurry up, and further we are also running a referral particular source over there, on which referring your friends for each sign up, if they join and further they sign up over there, you'll be getting rupees 20, and for each pack purchase you're going to get rupees 500 as a referral bonus, which you can be using for your purchases. And if you want to get the withdrawal of the same, you can also be getting the same. So do refer your friends right now. For the same, you need to visit the link in the description, again caib.learningsessions.in, and after sign up just navigate to the referral portal, and from there just copy the link, or you can just submit your friends and colleagues numbers over there, and further you're good to go, right? So let's start the session over here, and it's related to Spac, that is a special purpose acquisition companies. So Spac, or particularly a blank check company, is actually formed to raise money through the IPO so as to buy another company. So here it is the thing. It's a case that you want to acquire some company, or you want to get into to other company to merge into yourself, your companies over there. In that scenario, you'll be launching a Spac, and further you'll be putting it to the IPO, that is the initial public offering. People will be investing into your company. Now this particular money that is raised to IPO will be used so as to acquire, so as to buy other company, that is actually Spac. So Spac do not have their business of their own, so particularly they are there for the acquisition purpose only. And further, shares are structured as trust over there, and they can be having a face value of USD $10 per share, or more even that. Okay, and moreover, Spac will be having 2 years with them so as to complete the acquisition part, right? Once they have particularly launched the IPO, after that they will be having 2 years so as to find the target, and further they are to basically get the affirmation from the shareholders, and after that they are going to acquire the target. And particularly if they fail to get the acquisition done, or if they fail to basically find any appropriate target over there, in that scenario, what's of the money they have raised and what's of the profits they have earned so far, those are to be distributed among the shareholders again, and it will be liquidated, right? But the Indian regulatory framework, let me tell you, it never allows for the creation of the blank check companies in India. And the Companies Act 2013, it stipulates that the registrar of companies, that is ROC, can strike off the registration of company if the company does not commence its operations within 1 year of its incorporation. So okay, so it means if a company has been incorporated, but it has not commenced its operation, in that scenario the ROC can be striking out that particular registration, right? That's the main thing related to it. And further, after that, it's related to the money that are collected by Spac, that is to be placed where? That is to be placed in a trust account. Okay, let me showcase you this one. Let's take the case. Here we are having a company, that is a Spac, that is a special purpose acquisition vehicle, that is created. Now they basically launched the IPO, people invested heavily into it, and ultimately they got the funds. But now they will be placing these funds in some trust fund, who will be handling the funds over here, so that the interest of the shareholders is particularly reserved over there. And further, these funds can only be used for the acquisition of the company, and in the event, in the worst scenario, when the Spac is dissolved, in that scenario the money will be returned to the investors or the shareholders, right? Now let's just like few of the instances. Now the interest that is accrued from the trust account may be applied toward the aim of providing Spac with the working capital, because if the trust is particularly there where the money is kept, now let's say the working capital is also required as a routine expenses are to be made, day-to-day expenses are to be made, so that money will be coming from where? That money will be coming from the trust itself, right? Now, after an acquisition has been completed, Spac will typically apply to be listed on one of the stock exchanges over there, right? So once you are particularly, you can say, once you have completed the acquisition, in that scenario, the special purpose acquisition vehicle will be applying so as to be listed on some recognized stock exchanges. Now let's have a look at the advantages of the same. First of all, it's related to speedier acquisition. Now in previous scenario, I've basically told you that Spac merger typically happens between 3 to 6 months, but in case of the IPO, it generally takes from 12 to 18 months to complete over there. So it's a speedier acquisition related to merger of the SPAC into something, and further discovery of the price upfront over there. Now the price of IPO will be determined by the market. Now particularly when the SPAC will be raising the money at the time of its listing, the price of the share will be speculated, it will be determined, but the company that the particular SPAC over there is going to negotiate with the target company after the finalization of the same, right? So it's basically far more favorable strategy in the unstable market out there, and particularly the possibility of raising additional capital. Now SPAC sponsors can raise additional capital also through the PIPE. That PIPE is particularly what? It is private investment in public equity, right? So they can be raising more debt. Let's say case that SPAC raised 8,000 crores. Okay, just for the instance we are considering that SPAC raised 8,000 crore for the acquisition, but they need extra funds over here. So for that particular purpose, they can raise debt. Either they can raise a debt, or particularly they can go for PIPE, that is private investment in the public equity. They can go for these things also, right? And after that, it's related to reduced marketing cost. Now decreased costs are associated with the marketing or the SPAC over there, SPAC merger over there, because the market is actually not required so as to attract the interest from the investors out there. So reduced marketing costs are there, and ultimately ease of access to specialized operational knowledge. Now when investors, mostly the investors who are going to invest in SPAC, those are actually the seasoned businesses and those are the financial experts, so they can be providing their managerial expertise to the SPAC company over there, and also they can be acting as the board of directors for the SPAC too, right? That's the main thing related to advantages. And for the what are the additional advantages related to it, let's have a look at it. First of all, both the valuations and finances will be raised as well. What do you mean by that? Let's say the case that there is a particular IPO of SPAC. In that scenario, you're not basically clear about that in what particular company, what is a target company for this particular SPAC out there. So people are just particularly putting the money into it, and further they're just simply having the agenda that this particular SPAC will be acquiring some company so as to raise the value, and ultimately this will be giving a hype to the IPO, and ultimately when they acquire the company, it will be giving the overall valuation hike too, right? So these are actually advantages. Okay, and further it grants a greater degree of control over the stipulations of the transactions over there. And further, like I told you that the SPAC do not have any other operations of their own, so they do not have any other they are actually having lesser regulatory oversight, right? And further, when we are comparing IPO, when we are comparing it to an IPO, the process of going public with a high leverage company is made much simpler by the availability of SPAC. Now what do you mean by a leverage company? Where the part of debt is mostly used as to buy out a company. That's a leverage buyout, right? Now particularly in this scenario, what is happening, that we are raising the money by way of debt from the people out there, and particularly we are using the leverage. We can also be taking the PIPE or the public debt out there, and ultimately we're going to invest in companies so as to basically buy that particular company. So we can make use of the leverage in the same manner, but very easily using the SPAC procedure. Further, let's have a look at the disadvantages of the SPAC. First of all, it's related to inability to track use. Now definitely when you're going to invest in SPAC IPO, you're not having no idea where the fund will be invested, right? That's the first poor concern. And the other is related to poor returns, because the money which is going to be invested in SPAC, they do not get you that much returns involved in it. And ultimately what will happen, that the initial particular hype, when it goes off, you're not having that much hype in the valuations, also hype in the share of the prices, also you're getting poor returns over the same. And third one, it's related to low market cap. As I told you, that it will be the case that there is an initial hype related to SPAC over there, but ultimately it's going to, that bubble is going to burst out, and ultimately what will happen, you'll be having a lower market cap, that lower trading volume in the market out there. For the increasing regulatory oversight, now previously I told you that the regulatory oversights are lesser in that particular scenario, but SPACs have particularly lost their dieselness because there is increased regulatory actions which have been taken, and further it is actually very much difficult so as to work around such many particular regulations over there, right? And for the increased disclosure norms, now you have to declare and particularly disclose each and everything, that what are you going to do, what are your transparency, and how this money is going to be used, and everything related to it. Now new accounting regulation which has been issued by the SEC, that is the Securities and Exchange Commission, in 2021 over there. Now definitely after that, people are not filing doing that much things for the newer SPACs out there, right? Previously there were very much filings related to same, but now people are not basically concerned about, because there is very much increased disclosure norms, there is very much higher regulation degrees out there, right? That's the main concern. And further, the sixth one, it's related to shareholding dilution. Now, SPAC sponsors, particularly if we talk about the SPAC sponsors, they are holding 20% particular shares in the SPAC. If we talk about 100% shares in the SPAC, 20% of the shares of the SPAC are particularly held by their sponsors. Okay, so that's a quite scenario. And further those are particularly taken, and further, other than that, they are also having the warrants with them. They are also having the warrants with them, by which they can be purchasing the additional shares too, right? Now the SPAC sponsors ultimately are having this particular share in the SPAC out there. Particularly, they can also be diluting their shares into it. That is another disadvantage related to it. And for the deficiency in available capital, now initial SPAC investors may choose to redeem their shares. It may be the case that previously, that let's say case when we started a SPAC, in the case initial investors have poured their money into SPAC out there because they want to register the company and the other expenses are to be done. Ultimately, they have invested the money, which will be taken as a debt by the SPAC over there. And ultimately, when the SPAC was formed and the IPO was issued and further the funds were generated, it may be the case that the initial investors or promoters may redeem their shares. Okay, so that will lead to what? That will lead to deficiency of the available capital out there. Okay, let's say case that they have marked that they have spent 20 crore in initializing the overall operations of the SPAC out there, and particularly when the SPAC was all formed, they redeemed 20 crore amount of their shares. Ultimately, it will lead to what? It will lead to lower capital with you, right? And further, it's lead to compact time frame for compliances, because I told you there is now very high degree of compliances. There is why a very high degree related to transparency you have to make. So you have to do the SEC filing, that is a Securities and Exchange Commission filings also, those are to be done, and other regulations are also to be followed. So there is a very shorter time frame rather than in that is actually present in case of SPAC, as we compare it with the IPO over there. Further, it's leading to narrow scope for financial diligence. Now, SPAC process actually does not require any stringent due diligence. Okay, if we compare it to the IPO, the stringent due diligence is not required in case of SPAC, right? And further, it may lead to what? That when you are having not stringent regulations, those are to be followed, or due diligences which are to be followed, definitely it may be the case that you are basically leading toward potential issues or potential incorrections out there. It may be the case that you are having an incorrect business value or something like that, and it may also be causing more lawsuits over there. So these issues may arise in that scenario. And further, it's leading to absence of underwriting and comfort letter, because I told you that because target company in SPAC is already public, because the target company in a SPAC which you're going to acquire over there is already public out there, it does not have an underwriter. So in that scenario, the SPAC is not going to having an underwriter which will be underwriting the shares, that which will be processing the book building process or something like that, or which will be doing something like that if the issues are not particularly not subscribed over there. In that scenario, they will be underwriting the books over there. So those things are not present, and ultimately it's also be considered as a disadvantage. So what are the major disadvantages? First of all, it's related to inability to track the usage, poor returns, lower market cap is there, regulatory concerns are more, disclosure norms are more, and further shareholders can dilute their shares, and there is deficiency in available capital out there. There is compact time frame related to compliances. There is narrow scope for the financial diligence out there, and there is absence of underwriting and the comfort letter in case of SPAC, right? Now let's consider the SPAC formation and the timelines related to it. Now after the IPO, let's say case there is a SPAC which is formed, that is a special purpose acquisition company is formed, and further they issued the IPO, that is the initial public offering, right? They issued the IPO out there, and further for that particular purpose, whatsoever the proceeds of the IPO, those are to be kept where? Those are to be kept in a trust account. Those are to be kept in a trust account there. And SPAC will normally be having 18 to 24 months. They'll be having 18 to 24 months as to find and finalize the target, right? They basically need to find a company which they want to purchase, right? They basically need to find that particular firm over there. This is called what? This is called a de-SPACing, that they need to finalize the target, and they further are to complete the merger with it. They need to complete the merger it with it. That is particularly said to be what? That is said to be the de-SPACing process. That is the de-SPACing process. And further, if they're not able to accomplish a merger, if they are not able to accomplish the merger, in that scenario, the SPAC which was formed, it is to be liquidated. this particular SPAC will be liquidated, and whatsoever money that was there in the trust account, that will be actually be distributed among the shareholders, that will be distributed among the shareholders. That is the process, right? And further, the public shareholders of the SPAC have the option to vote against the deal. Let's say case that SPAC is there. Let's take the scenario that SPAC is there and they're having 18 to 24 months for despacking purposes, and in the meantime they found a target company, but the public shareholders who have basically invested into the SPAC over there, they can be basically going against this particular target. They can be basically voting against the same, that we do not want the merger with this particular target company, right? This may happen, right? And further, once the announcement related to merger has been made, after that this negative voice can be raised by the public shareholders, and further it may be the case they can also be choosing so as to redeem their shares. Okay, and further, if SPAC needs additional finances, let's say case they have redeemed their shares, the person who was have were negative, who were basically not affirming this particular target, they basically redeemed their shares, and after that particular scenario it may be the case that SPAC requires extra funds, so those can be raised by way of debt, or those can be raised by way of PIPE, that is public investment, private investment in public equity, right? That can be done through the same, right? And alternatively, SPAC may sell additional assets if it's the case that they are having redundant assets with them, which they may sell so as to basically raise much more funds, right? And further, it's related to SPAC merger. Now let's have a look at it. It's related to the SPAC merger. Now, SPAC will be required to seek the permissions of the shareholders. Let's say case they found the target company. Now they basically seek the confirmation. They do require the confirmation from the shareholders which they want to be merged. And further, it will also prepare and file a proxy statement. Now, SPAC will be doing what? They'll be filing basically filing a proxy statement or a joint registration or proxy statement if it intends to basically register the securities as part of the merger out there. So they will be filing this particular proxy statement over there, and this particular document will be containing a description of the proposed merger, that whatsoever is proposed, what are the different aspects related to this governance out there, that merged entity related to it. So those all will be explained in this particular document, and further it will also be including the financial information related to the company in which they are going to target for the merger over there, right? And those all will be covered, and financial statements will be covered, and further management will be discussing the overall analysis related to merger and acquisition, and further the merger will be finalized once, let's say case they have obtained the confirmation from the shareholders. After that the merger will be finalized with the target business in the transaction and further it will be causing what, that the SPAC was actually a special purpose acquisition company. Now it is now merged into some public entity or public company, and ultimately it will go public. Ultimately this company, the merged company, will go public itself, right? So the merger will be finalized, target business will be transitioned, and further it will be leading to what, that it's a public company now. SPAC is now a public company, and within 4 days of closing, that after the merging, it's related to form 8K or super 8K form must be filed with the USEC, that is a United States Securities and Exchange Commission. Okay, so it is particularly to be filed within 4 business days of closing, after particularly they have done the regulatory compliances, after they have particularly considered and further finalized the transaction out there. Ultimately after that, within 4 days, particular filing in the form 8K or super 8K form is to be done with the USEC, right? Further, it's lead to stakeholders. Now the stakeholders in SPAC, we are having three different kind of stakeholder groups over there. We are having the sponsors, and other than that we are having the investors who are going to invest, and thirdly we are going to have the targets, right? So firstly we are going to talk about the sponsors. Now sponsors are those who will be creating the SPAC, right? Actually SPAC is started by the sponsors itself, so their contribution is actually related to that they will actually be putting money which will be non-refundable fees. Let's say for formation of SPAC, whatsoever fees were paid, whatsoever attorneys they have hired or accountants they have hired, or particularly let's say every preliminary cost or pre-operative cost of running the organization, that will be put in by them, and sponsor will be particularly doing all these tasks on their own risk, right? Because if the registration is not successful or the transaction is unsuccessful, are going to lose their money, right? And further, if the transaction is successful, so they're having basically a huge risk associated with them, but in case they fail, they will lose the money. But in the case if they succeed, In case if they succeed in that scenario, sponsor receive the sponsors shares in the combined corporation. So let's say that particularly Spac was there and particularly public entity was there. Now they all are merged on the combined company. They will be getting 20% of the shares, right? So they'll be getting 20% of the shares in that particular combined entity out there. Now sponsor purchases certain type of shares of the company at a nominal price, that particular shares which are basically purchased at some nominal price out there. So that is the scenario, right? Now let's have a look at the characteristics of the SPAC. Before that, let me tell you about the investors. Investors are those who are basically subscribing the SPAC. These are the public shareholders, and targets is actually related to company with whom they are going to be merged, right? So that's related to the different shareholders, stakeholders in case of SPAC. For this related to, let's have a look at the characteristics of the SPAC. So once the public offering is completed, after that the SPAC will be traded on the stock exchange as units out there, and further they'll be have they other than that they will be having the common shares. So they will be particularly be there on the stock exchange, and also common shares or the warrants out there, right? Now warrants are actually related to what? Warrants will be based upon the equity shares in that scenario, that will be giving a right to the, let's say, QA base, that is a qualified institutional buyers or particular other buyers over there. They have invested into the warrants. Let's say upfront they have paid 25% of the amount, and once the transaction is completed and they found that the shares are beneficial for us, they can be paying for the another amount, and for the they can be acquiring the shares at a strike price, at a strike price. Now strike price is generally a nominal price at which time the IPO related to SPAC were issued. Let's say case on IPO issue date, the SPAC share price was, let's say, 100 rupees. Now in that scenario, the strike price will be 100 for the warrant purposes, right? Now after that, it's related to, because of the liquidity in the trading market, investors have the right, basically they can be exiting their position, because once they have issued the shares and your company is traded in public, now the persons or the investors who have invested into the SPACs over there, they can actually be selling their shares, and ultimately they can be diluting their shares, right? And further, the corporation is obligated to provide the stockholders of the target business with full disclosure. So every disclosure is to be made, which basically include the comprehensive audited financial statements over there, or particularly the terms of proposed business combination over there. Those all will be made transparent, and this all every information is will be available over there, and all the stakeholders of the SPAC are given the voting rights. So whatsoever the shareholders of the SPAC, they will be given the voting right as the shareholders. So in the meeting over there, so that they can be agreeing or disagreeing to the proposed things, like related to, I told you that SPAC is to be merged with some other company, with the target company over there. So the shareholders will be having a voting right, that whether they want to proceed with this merger or not. So on the case, let's take the case that they don't want the company to be merged. In that scenario, they can also be redeeming the shares. They can also be redeeming the shares, or they can simply be raising the world that we do not want that particular merger out there, because I told you that they are given, the SPAC is given a time period of 18 to 24 months. And for the, let's say, if this process they are not able to find the target company, or they are not able to complete the transaction, that is a merger transaction over there, in that scenario the SPAC will be diluted. The SPAC is to be diluted, and it will be liquidated, right? That was the main scenario. And further, now, SPAC is actually led by the experienced management over there, and actually, it must be including at least three people who are having the expertise in private equity, who are having the expertise in merger and acquisitions over there, and further, they must be have played the operating roles in the different companies out there. And management team of the SPAC is entitled to receive these. This is actually related to what? This is actually related to sponsors who will be receiving 20% of the equity in the combined vehicle, excluding they. That's actually related to common shares only. Other than this 20%, it may be the case that the people are also having the warrant, so that they can be buying another set of shares also, right? Because warrant actually gives them a right that they can be having the extra number of shares at the strike price, right? And in the event the management team is actually unable to successful the business combination, okay, in that scenario, whatsoever money they have invested initially, that will be lost, and further, ultimately whatsoever the assets were belonging to the SPAC over there, whether we are talking about the trust funds which were actually formed when the IPO money was coming, or it may be related to another assets which have been obtained by the SPAC over there, those all may be liquidated, and the money will be returned to the shareholders, right? Distributed among the shareholders. Further, it's related to process. Let's have a look at it. So SPAC is obligated to repay the funds to the investors after deducting the bank and broker cost. Let's say case the investment bank was there, management team was there. Now they'll be collecting a fees which will be equal to 10% of the IPO amount. which was actually equal to 10% of the IPO amount. And for the after deducting this fees, whatsoever the money that was accumulating in the trust account over there, that will be distributed, right? And during an IPO, securities are sold at a price per unit that corresponding to one or more shares of the stock, common stock. Let's say case the securities were also sold. On one hand, the shares were issued in IPO, and on the other hand, securities were also issued, right? Now these securities will be issued at a price of multiple of one or more units of the shares. Let's say case one unit of the share price was at rupees 100, so it may be the case that the securities are being issued at 3 multiple of the share price or 4 multiple of share price, or whatsoever the scenario it is, right? And further, if the business requires additional fund, as I told you, they can get the funds through the pipe, or they can get the funds in the form of loan in the market, right? Further, the money obtained from the IPO is placed in trust account, as I've already told you. That's the main scenario. And now let's have a look at the Spac capital structure. It's related to the Spac capital structure. Now the funds are often gathered from whom? These are gathered from the institutional and the retail investors. So let's say case Spac was formed. Now definitely retail investors can also be there, and also the money will be coming from the institutional investors. Institutional investors, let's say qualified institutional investors, or let's say case other case. Now they will be investing into the common stock, and also they will be having the warrants with them. They also will be investing into warrants so as to buy the shares afterwards at some convenient price, or let's say at a strike price. And after the IPO, the units can be split up into the warrants and for the shares of common stock, and for the can be sold on the open market. Now once the IPO is done, when the people have invested into it, now particularly after that, they will be having the units of the stock, and ultimately they can be selling the stock in the open market also after the same, right? Now after that, it's related to trust account. Now as I've told you, that sum equal to or greater than 100% of the proceeds that are received through the IPO. Now whatsoever the amount that you have received through IPO, 100% of the same or greater than that, that is to be placed where? That is to be placed in the trust account. That is to be placed in trust account over there. Now roughly 95 of the funds are coming from the general public, 95% funds coming from the general public, and 5% of the funds will be coming from the sponsors. Okay, that is actually from the general public, and for the 5% of the funds will be coming from the sponsors over there. And the money in the trust account, that can be kept as it is, or that can be, because that will be vacant right now, and so that can be invested into the government securities or no risk bearing securities out there. And further, whatsoever money that will be earned through the same, that can be used for the working capital of the Spac, or particularly whatsoever income, extra income that will be there if they're having any surplus, and if the Spac is liquidated. In that scenario, that profit is also distributed among the shareholders, right? That's the case related to it. And further, it's the case whatsoever the money lying there in the trust account, it can be used for what? It can be used for redeeming the shares of the shareholders, and further it can be used for the despacking transaction, and it can be used for the working capital transactions of the Spac company, right? Now let's have a look at the warrants over there. Now warrants whatsoever are there are actually purchased by the sponsors. Now sponsors will be doing what? Sponsors will be purchasing the warrants in whole. They will be purchasing the warrants in whole, whereas the units offered for sale for the general public are of include only a portion of a single warrant, right? So whatsoever the units of the shares which will be available for the general public, those will be basically indicating a part of the warrants, and ultimately all the warrants are actually owned by the sponsors over there. And share price at the time of the first IPO, I told you, share price at the first time of IPO, that will be basically what? That will be the strike price of the warrant in general. That will be the strike price of warrant in general. And public warrants are typically settled in cash. And further, the founder warrants are net settled. What do you mean by the founder warrants are net settled? It means whatsoever the strike price is there, and whatsoever the difference between the fair value market price, fair market value of the share over there, that is going to be set. Let's say case if a sponsor is going to redeem a warrant, in that scenario the difference between the same is to be paid to the sponsor out there. In other scenario, let's say case if the general public are having the warrants, or the institutional buyers are having the warrants, those will be settled in cash. That full amount will be paid, right? That's the main thing related to it. Further, it's related to IPO agreements. Now let's have a look at the different agreements over here. First of all, it's related to charter. Now charter will basically will be indicating what? It will be giving the full and fledged particular details related to the whole scenario, right? So document that actually establishes the public shares as well as the founder shares, including the anti-dilution modification. So related to whatsoever shares there are or dilutions there are, those will be indicated. And what will be the conversion ratio, that instead for getting one share particularly for one warrant, how many shares you'll be getting, and what will be the price of the same. Those all things are particularly indicated in the charter over there. And also it basically places a limitation. Okay, what limitation? That where the trust fund can be utilized. So it basically places a limitation on the funds which is actually placed in the trust account there, and also limit the application that where that particular fund can be utilized, right? That the fund can be utilized so as to repurchase the shares, for the redeeming the shares, or for particularly for de-SPAC transaction it can be used, right? That's all covered under charter, right? And after that, it's related to securities purchase agreement. It's related to the securities purchase agreement. In that scenario, whosoever the sponsors, I told you about the stakeholders, so the sponsors were there. So sponsors among with the SPAC, they will be coming under what? They will be coming under a securities purchase agreement, that is SPA. They will be coming under a securities purchase agreement, and further which provide for the issue of founders shares or to the sponsor of the SPAC over there. Okay, so number of founder shares is typically set at 25%. So it is particularly the number of shares will be ranging from 20 to 25% of the public traded shares, and initially registered as a registration statement out there. And for the number of founder shares may be decreased or increased through the stock split or dividend or even cancellation of the or the forfeiture of the same, right? So securities purchase agreement is actually between the sponsors and the SPAC, where it gives a right that sponsor will be having shares of 25% of the total number of the public traded shares. And further they will be having the sponsor number of shares can be increased, decreased, or particularly they can also be forfeited, right? Further, it's related to warrant agreement. It's related to the warrant agreement. So the SPAC and the transfer agent, so the special purpose acquisition company, and further the transfer agent, they will be signing what? They will be signing the warrant agreement. They will be signing the warrant agreement, which basically will be outlining all the parameters related to the warrant out there, that when these can be redeemed, what will be the strike price and everything related to it. And further the SPAC will be having the obligation that the SPAC is to particularly comply with the issuance of the shares over there, that whatsoever when a particular warrant, when a particular warrant is exercised, in that scenario the SPAC will be having the obligation that it has to issue another set of shares. It has to issue another set of shares as per the agreement between the transfer agent and the SPAC out there. Okay, so that is to be done, right? And further, to change the conditions of the warrant agreement, if somebody wants to change the conditions of the warrant agreement, at least 50% of the share warrant holders particular approval is required if you want to change the terms and conditions of the same. Otherwise, that agreement is between the SPAC and particular transfer agent, that whatsoever the conditions related to the warrant agreement, those are to be complied with, right? Further, it's related to promissory note. Now, SPAC actually do not have any kind of funds just to start the business, initial expenses, right? So SPAC is actually a blank check company. It is not having any kind of funds with it. So promissory note is actually related to between the sponsors and the SPAC. Now, sponsors particularly say what? The SPAC is actually promising the sponsors that it will pay the debt. So it will pay the debt whatsoever the amount which has been spent as initial expenses by the sponsors out there. There is an agreement, that is a promissory note by the SPAC out there, that it will be repaying all the debts. It will be repaying all the debts to the sponsors over there, right? So the sponsors agree to engage into a promissory note with the SPAC in order to lend the funds to the SPAC over there in form of loan until the completion of the SPAC's first initial public offering, right? So once the public offering is done, after that the amount of the sponsors which they have spent initially, that will be repaid back to the sponsors with interest, right? Further, it's related to sponsor constituent document. It's related to the sponsor constituent document. So in that scenario, a new LLC, that is a limited liability company, is established for the sole purpose of acting as a sponsor for the SPAC. Now in that scenario, what happens? That sponsors will not be basically counted as for a individual entity out there, but they'll be forming a LLC, that is a limited liability company for the same, and further they'll be becoming the directors of the same, and this LLC will actually be investing into this company, that is sponsoring this particular SPAC out there. And that is the funda related to what? That sponsor constituent document over there. Now the owners of the sponsor, now this is actually what? This is a sole sponsor. This is a sole sponsor, and let's say A, B, C are the directors, and these are the owners of the limited liability company. These are the owners of the limited liability company, right? Now they will be having a relationship with one another and the relative participation in the SPAC in writing out there, and they specify the proportionate amount of founder warrant purchase price, that at what price they will be purchasing the warrants out there, and further all the things related to it. Okay, so that's particularly agreement between these two, that is the sponsor and the SPAC over there. And for that particular purpose, a special new LLC is actually established, right? Further, after that, it's related to the letter agreement. It's related to the letter agreement. Now SPAC actually will be reaching a letter agreement with its officers, directors, sponsor before moving forward with the process. So once the SPAC is to move forward with the process out there, it has to basically reaches a letter agreement with the same, and whatsoever the lockup agreement is there, whatsoever the indemnification related to the same for its voting agreement obligating to the officers, directors, sponsor over there, that they will be giving a positive note to the D-SPAC transaction, that they will be giving a positive note to the D-SPAC transaction. That will be a letter agreement that will be signed between the SPAC and whatsoever the key authorities, key persons of the SPAC over there, right? And further, it's related to registration right agreement. That's related to the registration rights agreement. Now, for the benefit of the sponsor, let's say case there are sponsors and here we are having the special purpose acquisition company. So for the benefit of the sponsor and for the other holders of the founder shares or founder warrants over there, the SPAC enters into a registration rights agreement granting the sponsor and other such warrant holders or the shareholders, they will be getting the registration rights. They will be getting, so the sponsors plus the warrant holders plus we can say the founder shares, founder shareholders, they will be getting what? They will be getting the registration right with the respect to the founder shares or founder warrants or founder any other equity that is actually held by the sponsors out there. So that particular agreement will be between the SPAC and the sponsors out there related to that. They will be having the right of registration of these particular instruments, right? That's a registration right agreement. And after that, it's related to private placement warrants purchase agreement. Private placement warrants purchase agreement. Now, in terms, in accordance with the private placement purchase agreement, it is signed between the SPAC. The sponsor has agreed to purchase the founder warrants. So, SPAC actually will be selling the warrants to the sponsors of own, and further there will be an agreement related to the same. There will be an agreement related to the same where the sponsor has actually been agreeing so as to purchase the founder warrants, that they have actually agreed that they are going to purchase the founder warrants. That's particularly an agreement between the same, right? Now financing the purchase price occurs one business day before the conclusion of the IPO. So when the IPO is to be concluded, T minus 1 day, when the IPO is concluded, T minus 1 day, and further before the closing of any exercise of the green shoe option over there, this particular option is to be executed, that the sponsors are to actually purchase the warrants. Sponsors are to purchase the warrants over there. Now green shoe option is actually what? Green shoe option actually allows the group of investment banks that actually underwrite an IPO to buy and for the offer of for sale 15% more shares at the same offering price than the issuing company originally planned to sell. Now, what is actually green option shoe? Let's understand this with an example. Let's say the case that IPO is being offered by SPAC and for the unit share price is rupees 100. And for the let's say case that there is an agreement between the issuing company, that is SPAC over there, and the underwriter companies over there, that's these are actually the merchant banks, that if there is under subscription in that scenario, let's say underwriter is saying that they are going to purchase 5% of the shares, right? That is the agreement between the normal agreement, that's the underwriting agreement, right? But in the case of the green shoe option, the group of underwriters, they will actually be purchasing 15% more. They will be purchasing 15% more shares at the time of particulars at the same offering price, of the issuing company where they are basically planning to sell. They actually be investing 15% more, right? That's actually the case related to what? That's the green shoe option. Okay. Further after that, it's related to securities assignment agreement. Securities assignment agreement. Now compensation for the independent directors. Now let's say there are independent directors, right? Now the compensation to the independent directors is actually provided by the SPAC. So the SPAC will actually be providing the compensation to these independent directors in the form of cost plus sale of founder shares, right? So whatsoever the cost plus founder shares, they will be offered to the independent directors over there. They will be paid to the independent directors, and this is the only method that how the independent directors can be receiving their remuneration. Okay, so that's actually related to securities assignment agreement, and after that it's related to administrative service agreement. That's related to the administrative service agreement. Now monthly charge is actually paid by the SPAC to the sponsor. So whatsoever the sponsors are there, let's say case that there are sponsors, and sponsors will actually be receiving a monthly charge. Okay, in exchange for the sponsor will be providing, the sponsor will be actually be giving the another things. Let's say case office space is given, secretariat support is given, administrative services is given. So many services are being given by the sponsors out there. So particularly a monthly charge will be paid by the SPAC to the sponsors. That will be paid by the SPAC to the sponsors over there. That's actually the administrative service agreement. That's we are receiving the services from the administrative services from the sponsors, and in further in exchange the SPAC is going to the monthly charge for the same, right? And for the SPAC makes use of the regulations in the process of its formation of the this particular administrative service agreement over there, so no excess amount is paid. And after the IPO it will also sign into investment agreement management trust agreement with the trustee over there, right? And after once the IPO has been issued, so SPAC will also be signing another agreement, that is the investment management trust agreement with the trustee of the trust, which is actually created where the funds of the IPO are placed, right? And further this agreement will control the investment. So whatsoever the investments are to be made by the SPAC over there, this agreement will be controlling the same, and in accordance with the same, the trustee will be actually, the trust account will be giving the money, right? And further after that it's related to the de-SPAC process. Now, what is the de-SPAC process? It is to be completed within a period of 18 to 24 months. Once you have finalized the target company, you are to basically get approval from the shareholders, and further after that the approbation votes are to be given related to that the target is to be done, and ultimately the particular combination of the entities will be done. And within 4 days after the transaction, form 8K or super 8K form 8K is to be submitted with the SEC, that is a US SEC, that is a United States Securities Exchange Commission. Okay, that is to be done. And further after that it's related to redemption offer, that whomsoever investors who have actually invested into the company, because the shares are not publicly traded, now they can be selling their shares in the market out there, right? So as to basically get the money, right? That's the main funda. So first of all it's related to what? It's related to the shareholders approval. So the buyer in this case of SPAC needs to get approval from the shareholders that they want to go along with the company merger over there or not. Further it's related to founder vote requirements. Now, at the time of the IPO, founder shareholders like the sponsors or other shareholders, which are the founders over there, will make a commitment to vote in favor of the D-SPAC. I told you about this agreement, no? There was an agreement related to the same. That is actually letter agreement, that they will be positive in favor of the D-SPAC transaction over there. We are talking about that particular agreement, right? And for the at least 20% of the outstanding shares of the SPAC will be committed to the voting in support of the D-SPAC transaction. As a result, just 37.5% shares are necessary to accomplish the goal of majority vote, and so as for the approval of the transaction out there, right? That's the main thing. And what do you mean by redemption offer? That when once your particular shares are public, let's say case there was a SPAC company and particularly there was a target, now though both are combined, and for further the units are after that, because it was a public entity, now your units are publicly traded. That's the main fundamentality. Now it gives actually the owner of the public shares the option to exchange those shares for proportional shares of the profit stored in the trust account over there. Now the particularly redemption can be two ways. Let's say a SPAC was just formed, but some of the particular shareholders are saying that they want to go for the merger over there. They can be redeeming their shares. So the trust where the funds were kept over there, so if they were generating any of the revenues, they can be those particular revenues can be used so as to buy back the shares for the redemption of the shares over there, right? Now, redemption offer will not be valid for public warrants. I'm telling you, this will not be valid for the public warrants over there until such time as those warrants are either exercised, exchanged, or otherwise voided in accordance with the terms of usage, right? So particularly if Otherwise, you're going to redeem the warrants, that is actually not going to happen. And further, only that can be done only when the rights are exercised or something like that. Only then it can be done. Otherwise, it cannot be done. Okay. And further, if the time limit to finish the SPAC transaction passes, like I told you that you are having 18 to 24 months when you are to do the de-SPAC transaction. If that particular time passes, then it will be required to redeem the public shares in proportion of the shareholders, right? That is to be done. And for the if the de-SPAC transaction does not go through, if does not go through, so what's of the money that is lying in the trust account, that is to be given back. But the public warrants, founder warrants, they will lose their value in that scenario if the SPAC is diluted. I told you that if the transaction is successful, then particularly sponsors will be getting the benefit, 20 to 25% sponsor shares. And for the sponsor warrants, sponsor shares are given to them, right? But if the transaction never goes through, in that case, those all will be getting devalued and they will be getting nothing, right? So that was all related to the DSPAC transactions and all about it. So what are you waiting for? Just do enroll right now. Just don't sign up. We have to basically visit to our website, CAIIB.learningsessions.in. Simple website, that is CAIIB.learningsessions.in. Simply visit this website and further simply sign up over the same, which is absolutely free, and navigate to the PDF section so as to get all the PDFs out there. And further, you can also visit to the refer section over there and just referring your banker friends and colleagues. If they sign up, you'll be getting 20 rupees for each sign up. And for if they purchase any pack, in that scenario, you'll be getting up to rupees 500 as a referral amount, which you can be using for your purchase, or you can be getting all the withdrawal of the same, right? So that will be all. Thank you so much and see you again in the next video.